everybody. Welcome to the Trading Market Technicals morning call video for Thursday, October 24th. A little bit of a pause in the markets. Dow Jones down 54, Nasdaq down 22, S&P down 8, and Russell down 4. Noticeable weakness in the tech sector and now the banks. So this is something that could it just be a sector rotation? Possibly. Long's money's coming into one sector and coming out of one and into another. That's another story. But right now, word of caution here. Let's see if we get a little bit of a break in the markets, maybe 3 or 4 day pullback, which would be shallow if at all, and then look for new highs again. But I got to tell you, 9 days out of 10 straight up, you have to wonder. And I would definitely be cautious here. I wouldn't be so aggressively looking to add to new positions. Now, on the other hand, if you're looking for quality stocks that have pulled back and are basing and looking for the next leg up, that's another story. That's something that I will be looking to do in case this market does decide to go higher. But you got to really, one has to ask itself, you got to be careful here. Greed is definitely pushing this market higher, and this market is actually rallying only on the fact of the Fed. And that's fine. And, we're not looking for excuses. We're not looking to say, well, why it shouldn't be. Price is what pays us, and that's the bottom line. Whether we like it or not, if we want to make money in the markets, we've got to follow what the trend is doing. And also be cautious, too. There are some definitely red signs here, red flags, if you will, in the markets that indeed we might be looking for some sort of a pullback. But right now, it's only 1 day, and as I'm recording this, we're up about 7.5 handles in the E-mini overnight session. So it looks like, to me, as of right now, the markets have forgotten why they sold off yesterday, and that was partly due to China's data last night. So we'll just take a look. We'll keep it one step at a time. I want to go into some technicals, and I want to show you some of the indicators here. Right in front of you have the tick. The tick is actually holding up quite well here. We're still above zero. We did have that little bit of move lower, and every time we move lower, we climb back up again and moderately hold above the zero. That's fine. It's bullish. Really nothing wrong with that. So I do want to show you some bullish patterns that we're seeing. I'm not going to show you a bunch of them, but this is still bullish. Now, if you look at the stocks above the 50-day moving average, yes, it's bullish, but we are elevated here at these levels. So this is the area where we would get some sort of a pause or a pullback in the markets. Do we see a big, deep downside correction? We don't know yet until markets actually start to move lower and start taking out some key pivotal support areas. But right now, this is something that it's a word of caution. We're extended, we're stretched, and we're into the area, into the sell zone that stocks above the 50-day moving average. Take a look at the VIX. VIX really hasn't done too much, but I will tell you, back at these areas here, logical spot for a bounce. We did get a little bit of a bounce for 2 days, but nothing really to write home about. So let's see if the VIX can muster up a little bit of steam. If it does, then obviously that would give a sell signal to equities. But right now, as I'm seeing, this looks like only right this second a bear flag under the 200, under the 50, under the 20. A lot of overhead resistance. So as of right now, still kind of bullish, and I don't see a buy signal for the VIX at this time. Down in here, yes. Right now, we'd probably see the VIX dip one more time lower, see if we could take out this Bollinger Band here, or at least get back down to this main support area from 2013 and then rally. We shall see. Let's just take it one step at a time here, and let's take a look at our NYMO McClellan oscillator. Overbought territory. Came back in, as you can see, we touched the Bollinger Band, and we rolled back into this neutral state. Still here, a little bit overbought. I wouldn't say it's extreme, but again, plenty of room to run still to the upside. And this doesn't scare me. So, for instance, if we were to rally today and into Friday, we'd probably get back into this overbought state, and then we shall see what happens for Monday and Tuesday. But as of right now, like I said, we're still within this area here, so not too bad. Let's just keep an eye on this indicator. Very reliable indicator. New high, new low. We pop back into this area here where we would usually get a sell. We did roll back down into that 200%, but still above zero, so still quite bullish. But here, this is something where you want to keep when the markets are chugging along. This is what you want to see right here. You don't want to get these spikes, these big long spikes, because that's a sign where the markets start to, as you can see here, start to roll back down again. So and same thing with here. So far so good, but let's just see, we don't want these spikes coming back up here and making lower highs, and that's when the markets tend to start to terminate back up these areas here. Okay, I want to show you gold. Take a look at gold daily. We broke this bearish symmetry of lower lows and lower highs. We are now back up above it. We're just underneath the 50-day moving average. I do see gold moving a little bit higher into this area here, which I would love to get an opportunity to sell gold short up in these areas here. Take a look at gold weekly. You see what I mean. We do have a bull flag in this weekly chart of gold. Here's that little spot which is breaking out of this week. So maybe next week we rally up here. But look at what you have here. You have a death cross, 50 and the 200 rolling over. This will not go unnoticed to fund managers, just so everybody knows. This is a death cross. So we'll see what happens at the end of the week. My guess is this continues to cross over, given the death cross, and this just entices me even more to get short gold. Okay, take a look at palladium, and this is why I said, maybe in the short term we get a little bit of a pop. We did palladium, our secret leader, rallied back up, caught this downtrend, upper end of this downtrend line of this symmetrical triangle, and now probably needs to pause a little bit, creating some sort of a bull flag, and breaks out again. If palladium breaks out, gold eventually, along with other precious metals, silver, copper, they will break out as well. Okay, so let's just keep an eye on this going into next week. I don't see you trading gold at the moment, but it's something to definitely keep an eye on. You want to stalk that. All right, now here is the E-mini. We did reach our first extension of 1751, the 1272 extension, and now we are, this is the red candle is yesterday, and this is the overnight session at the moment. As you can see here, we are up 7 handles. I think the markets literally are on drugs. It's just absolutely insane that you get 1 day up, 5 days down. 3 days up, 1 day down, 5 days up, 1 day down. Now we have 1 day down. Does the pattern start again for another 5 days? Well, if that is the case, the next extension comes in at 1781. And I know it sounds ridiculous, but believe me, I would not put anything on this market. Remember, this market is fueled with greed and with the Fed pumping in tons of liquidity into this market. So you cannot fight the Fed. However, with this market and a lot of these high beta names really just overextended. I mean, we're having 3 to 5% moves on these high beta names. Google, Chipotle Mexican Grill, Netflix up 30 handles, down 20 points. It's just absolutely ludicrous, and that's why you have to be very careful here in this market. I am personally seeing a lot of these high flyers starting to take it on the chin. Tesla, good reason. Well, Google has made new highs yesterday. Fantastic company, fantastic stock. Just $1,020. Priceline over the $1,000 mark. It's just, is this really sustainable? And this is something that you have to ask yourself. Although we do need to make money, we need to trade. So just something that I would use a word of caution here, because this could end rather quickly and real fast. This market could be ending up, 10, 20, 30 points lower. And the crazy thing about it, at 20, 30 points lower will put us right about 1700 and still be bullish. That's how crazy it is. But remember, moves, when they do terminate to the upside and they start head lower, you do have a quicker downside move, meaning that you wipe out most of the move in 4 or 5 days. So just be cognizant about this, all right? And to make sure that if you are long, not to be adding too much of a long exposure up at these levels, because when the market does turn, if it does turn violently, all of these longs that are buying up here are going to be totally trapped. And so what happens is the market will rally, sell off, and then once we get a little bit of a retracement rally, they'll sell right into that again, and then the market rolls over again. So just a word of caution. Okay, let's take a look at the GLD. Now, here's a long-term uptrend line here in dark red. And here is the downtrend line of this little area here. So you can see this looks like really like a little bullish fallen wedge pattern, right? But it's the lower lows and lower highs. We did break that bearish symmetry. We broke out of this bullish fallen wedge, and now we're back above the 50-day moving average. So I would love to sell GLD right up in this area here, 137, 138, and again, here's that 200-day moving average continuing to roll lower. So gold is in a bear market, as I've showed you many times on a monthly chart. I am looking to sell gold, not at these levels. I do think we're going to get a pop, but that's going to be a great selling opportunity. Let's take a look at USO. I mentioned this head and shoulders pattern. Here was the neckline. We broke right down. We failed miserably. And we also gapped lower of the 200-day moving average. This, to me, now is starting to entice me to look to get long. I did Fibonacci retracements from here, low to high, and we are looking at the 61.8% retracement right here coming in at 34.12. So this might be a spot here looking for a trade. Now, this is a counter trend trade. Remember, we're making lower lows and lower highs, so you want to be really careful. Your stops would be, obviously, if you can risk down below here, it's a better bet. You'll give it a little bit more time to work. But this is easy to manage if you can get the, maybe another 50, 60 cents lower and see if this thing can base. I wouldn't say just if it gets there in price. Let it base a little bit. Let's get a reversal candle, take out the previous day high, and then for a counter trend trade, maybe back up to the 200 or so for a trade. That might be interesting. But again, if that's not your type and not for your trading plan, don't do it. But I just want to let you know where we are here. You can see this big head and shoulders pattern, so it worked out real nicely. The bearish pattern did work out, and now we're coming into some good support. You see the volume profiles, the volume zones here. We had that weak, thin zone here. And as soon as we broke that, you could see it was just a quick magnet back down to this area here. So it does work, guys. Technical analysis does work. Okay, let's take a look at the spiders. We have two fib clusters way below. This area and this area is what I would be looking for. I mean, we're way away from this. We're just about almost about 9 points away. Even if the spiders drop to 172.60, that's the 8-day moving average, which is ridiculous. I just amazing how this market just refuses to go down. This is where would be the first area, and then of course the 20, and then the fib clusters down here. So these are the areas that I'm watching for to see how price handles these areas here. But when you get this extended, guys, you have to. This is just a revision to the mean, just normal revision here back to the mean of at least the 8, or even back in between the 8 and the 20. I mean, it's just virtually almost impossible that the market rallies this hard, and then one day now, if it rallies again, I would be even more cautious on the market, because now you're having, like, again, total greed just coming in, buying this market up and chasing the market. Now, I did mention many times that a lot of these fund managers and mutual fund managers are underperforming the market, and they need to put money to work, and that's the case. However, most managers understand the revision to the mean mentality, and they're not looking to put money to work at these lofty levels and only have the market come down on them and now really underperform the market. Remember that most of this area, most of this run up in these areas here are all retail. So you need to understand that. Remember, the market is made to fool the masses. Keep that in mind. Okay? Take a look at the other indices. Take a look at the diamonds. Again, a little bit of a pullback. Not much. Still bullish, holding the upper end of the range, but yet underneath that November 2012 uptrend line here. Here is the IWMs. Again, still hanging above the upper end of the Bollinger Bands. 2 standard deviations now, remember. So revision back to the mean would be logically to 107, 108. And if that would happen, that would put us into November, which we come into some seasonal strength. Then you could start looking to nibble into some longs, but not up here. I mean, I would really be cautious, guys. Again, transports, our leader, doing fantastic. Why? Part of the reason why is oil has been decimated for the last 9, 10 trading days. Puts a bid into the transportation sector. Sure, we need fuel, right? So this is actually doing well, which will prop up the market eventually. But again, a logical pullback back to the revision to the mean here, coming into this area here, this horizontal trend line support, or here. So these are the areas, and these are the sectors that I want you to keep an eye on during the day. Goldman here, I still like Goldman. Longs it holds above the 156.16, which is this little area, this little horizontal area of support. If it breaks it, you got to get out. And only reason why, you're going to be able to buy this cheaper at the 200-day moving average. Now, it did hold, and it didn't get quite there, but but it is actually holding steady here. So I do like Goldman. I'd like going better above 160, and then at least a shot to the 170 again, back up to these areas. Hit his double top. But I do like Goldman still holding steady. If we start to lose it, then you got to get out of it. You got to ditch. But easy to manage, as you can see. Take out. Well, take out yesterday's high, 158. Your stops would be somewhere around 155 and a half. So, buy some calls or, a put credit spread, something like that. Something to make it easy to manage that you don't have to worry about, and position size it correctly to your trading account, you'll be fine. XLF. Now, here is what kind of worry. Like Bank of America, they had that, they got a ruling about their law with Countrywide that they have to pay a huge fine. JP Morgan, same thing. So banks are starting to come under pressure. Now, it just could be just a small pullback, and then the banks get bought up again, which is fine, but we have to keep an eye on it, because now when we have banks and the tech sector starting to get weak here, it's just something that you can't go unnoticed. Let's keep an eye on it. Right now, it's just a pullback, which is fine. We need a pullback after this 9-day run. And we're approaching the 8. Let's see how far this does pull back. If it can base and steady and start to move back higher and take out highs, then obviously it's worth doing. We need pullbacks. We need pullbacks to regain momentum and regain buying pressure. When the markets gets frothy like this, what happens is that you lose momentum, and there's really how many more people are going to be buying at these levels. Now, aside from retail, when retail buying, it's just unsustainable. But when you have fund managers and funds putting money to work at these levels, then indeed it will in fact push this market much higher. So you have to really realize what's happening here. It's easy. When it gets too easy, you have to take a step back. And lastly, Apple. Apple's doing quite well here. I would tighten up stops. You're coming into some resistance here. Again, I would not be looking to buy Apple here. I wouldn't short it, but I wouldn't buy it here. I look for a deeper pullback to add to a long position going into the Christmas season. And lastly is the Qs. As you can see here, Qs did quite well, but we have these topping tails, we have these spinning tops, and these dojis. You have to basically. Doesn't say that's we're looking for a quick sell-off, but it's just indecision. Momentum is starting to wane a little bit. So just keep it steady. Be nimble with your trading. Be selective in your trading. And please do not get stubborn. If you have a stop, take the stop and move on. It's the best advice I can give you in this crazy market at the moment. Okay, guys, we'll see you tomorrow. Have a great day. Let's see what happens. We're still up about 7.5 handles in the minis. Looks like the market forgot about yesterday. And let's see if this can hold into the opening this morning. Have a great day, everybody.